Here's what you need to know about the most popular inflation hedge. Gold prices hit another record high last week following President Donald Trump's latest tariff threats. Its 9th peak so far this year. Gold is a commodity like no other. In contrast to other hard assets, gold plays a unique role in the global monetary system. Simply put, gold is perceived as money. Let's examine some key factors driving gold's performance and what it means for long-term investors. Gold prices have climbed to record levels around $2,900 per ounce, driven by Federal Reserve rate cuts, heightened geopolitical tensions, and ongoing fiscal concerns. The latest rally in gold has been largely driven by record purchases from central banks and individual investors. World Gold Council data shows that central banks purchased over 1,000 metric tons of gold for the 3rd consecutive year, and investor purchases of physically backed gold ETFs pushed their total assets under management up by 26%. Fund flows are always influenced by investor sentiment, which throughout the past 12 months has been dealing with geopolitical risk as well as the US election and an unusually large number of other high-profile elections around the world. Many investors view gold as a potential hedge during periods of inflation and global uncertainty, though it provides no yield or income unlike bonds and dividend-paying stocks. While gold outperformed during the 2008 financial crisis, it has generally underperformed the stock market over longer periods, highlighting the importance of maintaining proper perspective. This chart shows gold's historical relationship with the stock market, illustrating how gold can sometimes move in different direction than stocks during periods of market stress. This relationship helps explain why some investors view gold as a potential portfolio diversifier. On a long-term basis, gold prices generally outpace inflation. Since 2000, gold is up 10 times, while the US CPI has doubled. Gold gained during the global financial crisis and the early part of the COVID-19 pandemic. On the other hand, after gold overshot to the upside in the wake of the financial crisis, it went into a bear market during 2013 to 2015. This chart shows that, counterintuitively, gold underperformed as inflation peaked in 2022, but then outperformed as inflation slowed. It's likely that most of the easy money in gold has been made, and the recent gains, largely driven by sentiment, have left the gold market vulnerable to pullbacks. As a base case, many strategists expect gold to be range-bound over the next 12 months around current levels, although volatility will likely be elevated during that time. Regardless of short-term price movements, it's important to remember that any allocation to gold should be considered as part of a well-diversified long-term investment strategy rather than a means of trying to time the market.